How dividends and capital gains distributions from a mutual fund are taxed? I certainly can. So, Sarada, if we didn't have subchapter M, or the conduit or pipeline theory of taxation, what would happen is if the mutual fund owns the stock and the corporation makes money, pays taxes, I'll just use me, for example. Let's say I buy Bank of America. And Bank of America has a 21-cent quarterly dividend, so that's 84 cents. Let's say that, Dean has 100 shares. So I'm going to receive $850 or $840 in dividend income, a distribution. Now, when you think about it, Bank of America paid taxes, and then I paid taxes again on those dividends. So that money that Bank of America made and then distributes part of it to me as a dividend has been taxed twice. It was taxed by the IRS to the corporation. Now it's taxed to me as a dividend. If we didn't have subchapter M, or the conduit or pipeline theory, what would happen in my Bank of America example, Bank of America would pay taxes, distribute a dividend to the mutual fund. Let's just say it's the Fidelity Magellan Fund. They would know Bank of America. Let's assume they do. And then they would pay taxes, then distribute that to me, and I'd pay taxes. The IRS has been kind enough to say that as long as a mutual fund and REITs, same rule for REITs, pass through at least 90% of their net investment income, the dividends from the stocks in the portfolio, that's the D, good way to remember it is DI 90, plus the interest on the bonds in the portfolio, less the expenses, as long as they distribute at least 90, most funds do 99.9, but at least at 90, the IRS will wait and get the money from me, from the mutual fund shareholder. So the dividends are being passed through to the mutual fund shareholders, and they owe taxes on it. Now, some mutual funds say, Dean, if you'd like, we have, very testable, a dividend reinvestment program. We love making up names out of things. Dividend reinvestment program. Sarada, very testable. That's called a DRIP. A DRIP is a dividend reinvestment program. That's where I tell the mutual fund, I don't need the dividends. I don't need the capital gains distributions. Just put those and reinvest back into the fund. The IRS says, well, Dean, as far as we're concerned, you could have got the money, and that's the same as getting it. That's called constructive receipt. So I'm going to owe taxes as a mutual fund shareholder on both dividends distributions and capital gains distributions. Again, the mutual fund wouldn't pay taxes on the capital gains. They could be passed through to the mutual fund shareholder unless they don't meet the requirements, and then they're going to be not a mutual fund, right? So their mutual fund isn't being taxed. The mutual fund shareholder is. Now, the holding period for capital gains, Sarada, is based on the mutual fund, how long they've had the stock. So I just told you Fidelity, for example, owns 10% of Alphabet. They've owned it since the IPO. They've owned it for way more than a year, 20-something years? And if I buy the Magellan Fund tomorrow and they sell the Alphabet stock and I get a distribution, that's a long-term capital gains distribution, because the holding period is based on how long the fund has had the stock, not how long I've owned the fund, right? So that's how dividend and capital gains distributions are taxed. They're taxed to the mutual fund shareholder, not the mutual fund, as long as they meet the requirements we've discussed. And remember this idea, whether you reinvest or not, you still owe taxes, that concept of constructive receipt in the DRIP.